Welcome to Introduction to Business Online Management 111, offered by Harper College. My name is Dr. George Mochocki. This is a conjunction with Blackboard Course Management System and McGraw-Hill Connect and Learn Smart Integrative Software. This week we're going to be talking on one chapter, and I'll be on banking. That'll be chapter 20. It's going to be the last chapter that you're going to be doing any kind of a homework assignment and reading. Next week you're going to be going into your feasibility study, and we're going to spend most of our time. We only have one or 2 more weeks left, and then you'll be turning in your paper, and you'll be doing the final, and it'll be over with. Departmental final covering all chapters. So what do we have this week? Let's talk about a little bit on financial management, or the Federal Reserve, or the central bank, and who's in charge of the Federal Reserve? Ben Bernanke. And if you look at the Federal Reserve's going up and down, there's a lot of things going on. When we look at the form that we'll be talking about the banking crisis, derivatives, everything else that you want to do, and you'll be doing some research. So you'll be surprised when you find out on your own what really happened, whose fault was it, or the economic downturn. Was it just strictly all the bankers or Wall Street, or did business and individuals have some input into the disaster? Okay, so make sure the Federal Reserve, was appointed, Ben Bernanke was appointed by George Bush in 2006. President Obama reappointed him in 2010. And everything with the Federal Reserve, if you look at Ben Bernanke, if you look at this chapter here, remember earlier we talked about economic adjustment. So you look at the fiscal policy. That's where the government either more spending or raise taxes. That's where right now we're looking at this fiscal cliff that's coming around. That's all dealing with the fiscal policy that we're talking about, or the Congress and everyone in the government's talking about. But what we have to look at, what Ben Bernanke, the central bank, is control of the economy. It does other things. It basically looks at the Federal Reserve controls the economy by either selling securities, discount rate, reserve rates, and all these things that you're going to find out from this chapter. So when you're looking at, notice the difference between barter and standards, money supplies, you have M1, M2, M3. M2 basically is checking, savings, and any kind of real quick liquidity. And M2 is what is normally used in most economic equations. But make sure you know the other ones. Okay, what's the global exchange rate? A strong dollar, is that good for the U.S. or is that bad for the U.S.? A strong dollar, we buy a lot of more stuff, but we don't need to buy any more stuff. We need to sell stuff. So a weaker dollar is more to our advantage, because people will look at our goods at a lesser price and buy more of it. So then we become the low provider, for lack of better words, if you look at it from an economic perspective. The Federal Reserve System, it looks at the economic condition of a country. It's looking at kind of an average. It basically looks at 5 Federal Reserve banks. Chicago's in District 7 when you look at that. So if you look what's the economic condition of District 7, we're kind of growth or we're stagnant. Now remember, when you look at the economic condition from the Federal Reserve, when it says the U.S. economy is going into recession or coming out of recession, they're looking at all different 12 reserve banks feeding information about unemployment rate, inflation rate, purchasing power, all this information from the 12 different districts are compiled as an average, and that's where they say where the country is going. Because you may have, looking at right now, some people are saying we're in a recession or coming out of recession. There's parts of the United States that's a recession. Everything's going well. What recession? Prices are doing well because that part of the economic district or region is not suffering, because it has the factors of production, or that you've read from economics, under control. Okay, factors of economics, production, land, infrastructure, education, everything else that ties into that. Okay, so you got what are the 3 tools the Federal Reserve use? Remember, when I'm looking at the taxes, raising taxes or lowering taxes, is how do I take money out of the economy or put money back in the economy? They basically have the reserve requirements. So if the government, the bank wants to slow down inflation, it basically raises the reserve requirement. That means how much money does, in individual banks have to always keep in the banking system that they can't borrow anything else. And so if they raise the reserve requirement, that basically means that less money they could give out to loans. So they're trying to slow down the system. They want to stimulate the system. They lowered the reserve rate, so now the banks have more money to give out to the loans. Open market operations is selling U.S. Treasury. So when they sell they print so much. When they raise the debt ceiling, when they raise the debt ceiling, Congress raises the debt ceiling or maintains the debt ceiling, it basically is going and saying there's so much money you could print. So the government has so much money, they sell bonds. Bonds are basically IOUs. So when they sell the bonds, that amount of money that they could have is no longer available because it's a debt that they're paying off that they're utilizing. So if they want to stimulate the economy, they buy those U.S. Treasury bonds back, and that's putting money back into the economy. So they control the open market. And when you look at securities, that's basically stocks and bonds and everything else that's investments that we could trade going back and forth. Okay, what's the discount rate? The discount rate is just a fancy word for the interest rate. So if the Federal Reserve lowers the discount rate almost like it is now to zero, that means if I get money from the Federal Reserve, let's say at 1%, I get it for 1%. Well, as my interest rate. Will I give that 1%, carry that over to you? No, I'm a bank. I'm a business. Come on. So I'll add a handling charge. So you may get it for 2% or 3%. Usually, if I get it for 1%, you'll be paying 2 or 3% depending on your credit worthiness. All right. So make sure you know the difference between a demand deposit, certificate of deposit, what's the time deposit. Those are different things between savings and checking. When in business terminologies, know the difference between the savings and loans. What are credit unions? What are online banking, some changes with smartphones, personal financing, free credit scores. Just because you have money, there's a lot of people who have international banks. There's nothing wrong with a Canadian bank, but does it have any kind of insurance for the money that you have in there? The federal FDIC is for American banks. Now, I'm not saying that the Canadian banks don't have an insurance policy in case for a certain amount in case the bank goes insolvent, but you have to make sure. Don't assume that all banks have insurance. If the interest rate is high, it may not have some kind of insurance in case the bank goes under. It may not be backed by the host government, like the Canadian bank or Japanese bank that you have your money in. Future banking, internet banking is a big one. International bank, banker exception, money exchange. Know the difference between the World Bank and what the IMF is doing, International Monetary Fund. So there's a big difference. Know what money is, and I think that's basically it. So what do we have today? Next week we're going to really be focusing in on your feasibility study. But in this week, your form is what you're going to be talking about. Is you're going to have one quiz, which is worth 20 points, 10 questions, 2 points each. You have one McGraw-Hill Connect, which is worth 20 points. Again, it's an easy McGraw-Hill. I think it's a presentation mode. So those are very easy 20 points. And you have a form. The form is worth 30 points. So you have 20, 40, so you have 70 points. I increase it to give you some more things. What you're going to do in a form, you can do some research. What happened to the banking crisis? Where did it go wrong? What is the new crisis going in? What's this fiscal cliff we're talking about that is coming up? What standard? Are we underneath the gold standard? Are we underneath the silver standard? Or are we underneath in God we trust standard? And I think you'll be surprised at what standard the U.S. dollar is back. So if I go with my dollar, what do I get out of the U.S. dollar? After reading the articles, what you think caused the banking crisis. Look about derivatives. What the big issue now is with the market is derivative. So you have people who are hedgers, basically buying in advance, which is okay. But then you have speculators. They're just buying it and buying it a lot with a low amount that they have to invest in, and are they manipulating the markets inadvertently to their advantages. So they're playing games and inflating the markets or moving the market one way or the other to get an advantage in selling whatever instruments they have, whether it's a debt instrument or equity type of instrument. So that's worth 30 points. So remember, when you find some of the sites and the websites, make sure you put them into the forums, and we should be good. And start working on your business, your feasibility study. I've got PowerPoints in there. I've got concept master and PowerPoints. I got a real real short version of PowerPoints, and you go to the next thing, it's more longer. You have concept maps, you have a short YouTube, and what's required. Remember, you're talking about 150 points. Those will bring a lot of views up. Most of you are doing very well. You're in the B's and A's. You want to come on. You're almost at the finish line. You only got a few more weeks. You'll turn in next week. We'll talk about it. By Friday next week, you'll be turning in your feasibility report. You know, it's like 6 to 7 pages, 5 to 7 pages. I think it's like 1,800 words or whatever it is, 300 words per page, give or take. You send that electronically. You get those points, and you'll take a departmental final, which is all the chapters, and that's not too bad. So you should be pretty, and you'll be over it, and then you'll have time for your semester break to enjoy, and then you'll start all over again, and you know, either I'll see you online or one of my face-to-face class. So again, my name is Dr. George Mochocki. This week we're covering Chapter 20, the banking, central banking. Remember, we're talking about the U.S. central bank. There's other central banks. European Union has, the EU has its own central bank, for lack of better words. You have different central, China has a central bank. So when you look at central banking and you look at it global, everything else is different, but they run fairly similar to what our domestic bankers are, only have different rules and conditions. All right, so I'll see you online. It'll be interesting to see your ideas, what caused the banking crunch, what's going on forward, how the Federal Reserve is changing. Is it gonna? Are we gonna have another recession? Is the Federal Reserve doing everything it can? Remember, the Federal Reserve is just one aspect of of how to manage the economy. The other one is the fiscal policy, and that's with taxes, everything else. And the Federal Reserve does with a discount rate, the reserve rate, and open market selling securities. Between those tools is what makes our economies either thrive or go stagnant. And remember, try to find out what kind of standards we're on. When you see the dollar and it says, "In God we trust," it'll give you a new outlook on since is it a gold standard, is it the silver standard, or what standard are we under that's backing the U.S. dollar, and why does it what makes it so vital and strong, if it is strong, in the world economy. I'll see you online. Have a nice day. Bye.